Before we begin, let me share something Wall Street rarely says out loud. You don't need brilliance. You don't need forecasts. And you definitely don't need a high-fee manager in an expensive suit controlling your future. What you truly need is clarity. A few principles grounded in arithmetic, history, and human behavior. Follow these 10 rules. Really follow them and you'll outperform most experts, market timers, and complicated strategies that confuse more than they help. These aren't theories. They're facts. And if you let them guide you, wealth becomes something steady, quiet, and nearly inevitable. Let's begin. Rule 1, reversion to the mean. In investing, reversion to the mean is as close as we get to a natural law. When performance rises too far above normal, investors assume the magic will continue forever. But history says otherwise. Every fund, every manager, every superstar strategy eventually drifts back to average. Not because someone failed, but because cycles shift, trends fade, and expectations return to reality. Yet investors keep chasing the latest winner. And Wall Street encourages it because it fuels their marketing. Your advantage is to resist the temptation. Ignore performance fads. Respect long-term data. Over time, the market rewards patience and punishes excitement. Trust the long term, not the hot hand. Rule 2, time is your friend, impulse is your enemy. The greatest force in investing isn't intelligence. It's time. Compounding works quietly, powerfully, and relentlessly. But it can only help you if you stay out of your own way. Fear pulls you out of the market. Euphoria pushes you in at the top. Both reactions feel natural and both are destructive. Financial media amplifies every market twitch as if your future depends on it. It doesn't. Wealth comes from staying invested, letting time do the heavy work, and refusing to react to noise. If you stay calm and consistent, you'll outperform the vast majority of investors simply by avoiding impulse. Rule 3, buy right and hold tight. Buying right means owning the entire market, not a few stocks, not a trendy theme, not a story that sounds brilliant today. When you buy the whole haystack, the needles take care of themselves. Holding tight means sticking to your plan when the world feels uncertain, when headlines scream, when markets plunge or surge. These moments test your discipline. They tempt you to act, but action usually hurts more than it helps. Success doesn't come from predicting what happens next. It comes from staying committed to a broad, low-cost strategy through every climate. Buy broadly, hold faithfully. Let discipline, not emotion, guide your future. Rule 4, have realistic expectations. I often compare investing to breakfast. Long-term investing, the patient, steady, low-cost kind, is the bagel. Simple, solid, reliable. Short-term speculation is the donut. Sweet, exciting, and ultimately hollow. Many investors expect the market to deliver excitement every year. When it doesn't, they abandon their plan at the worst possible time. Returns come in waves, some thrilling, some dull, some disappointing, but over decades, they add up powerfully for those who stay disciplined. Set expectations rooted in history, steady growth, some volatility, and a long journey that rewards patience, not impatience. Choose the bagel. It builds real wealth. Rule 5, forget the needle, buy the haystack. Wall Street loves selling the fantasy of the perfect stock, or the genius manager, or the secret strategy. But consistent outperformance is incredibly rare, especially over a lifetime. Chasing the needle leads to stress, disappointment, and unnecessary risk. The better approach? Own the whole haystack. Low-cost, broad market exposure lets you own every company, including the future winners, long before anyone recognizes them. You stop guessing. You stop chasing. You simply participate in the growth of the economy itself. It's the beauty of simplicity. Own everything. Keep costs low. Let capitalism work on your behalf. Rule 6, minimize the croupier's take. The financial industry is a very polished casino, and every investor pays the croupier, the managers, brokers, and middlemen. 1% seems harmless, but over decades, that tiny fee can consume half your lifetime wealth. Half. Most investors never notice it happening. Costs matter more than nearly anything else you can control. Lower costs mean higher returns guaranteed by simple arithmetic. Cut fees ruthlessly. Keep more of your money working for you, not for someone else. It's the closest thing to a sure win in all of investing. Rule 7, there is no escaping risk. A lot of investors try to avoid risk by hiding in cash. It feels safe, steady, comforting, but inflation works quietly, silently, relentlessly. Your purchasing power shrinks every year you stand still. Stocks and bonds fluctuate, yes, sometimes sharply, but over time, they deliver growth, the only antidote to inflation. The real question isn't how do I avoid risk? The real question is, which risk am I choosing? Temporary volatility or permanent loss of purchasing power? A balanced mix, aligned with your needs, remains the wisest path. Accept risk thoughtfully and use it to your advantage. Rule 8, safe isn't really safe anymore. Many traditional safe investments no longer offer the protection people expect. Money markets yield almost nothing. Bonds barely beat inflation if they beat it at all. Investors cling to these options because they mistake stability for safety. But real safety is the preservation of long-term purchasing power. Without growth, your future quietly shrinks. Equities, even with their ups and downs, remain the most reliable engine of long-term growth. They test your patience, but reward your discipline. Avoiding stocks may feel conservative, but in today's world, it is often the riskiest decision of all. Real safety is growth. Growth keeps you ahead. Rule 9, stay the course. If you remember just one rule, let it be this one. Stay the course. Markets rise. Markets fall. Headlines panic. Experts predict with great confidence and often little accuracy. All of it is designed to shake your conviction, but abandoning your plan during chaos is the most costly mistake an investor can make. The winners aren't the fastest or the cleverest. They're the ones who remain steady, calm, disciplined. Investing is not a game of quick moves. It's a long-term commitment to a simple, durable plan. When fear rises, stay steady. When greed spreads, stay humble. Above all, stay the course. Rule 10, the magic is in simplicity. Wall Street has a love affair with complexity. It looks impressive. It sells well, but real investing success comes from simple principles. Broad diversification, low costs, patience, discipline. If your strategy is so complex you can't explain it clearly, it's probably built to benefit someone else. Simplicity endures. Simplicity is transparent. And simplicity keeps you invested, which is where the real magic happens. The more straightforward your plan, the more powerful your results. Simple wins every time. These 10 principles aren't predictions. They're the lessons of history, arithmetic, and human behavior. That follow them, and you won't just build wealth, you'll avoid the traps that have destroyed fortunes for generations. Stay the course. Keep it simple, and let the quiet power of compounding do what it does best.